Hello friends, this is Raj Sastry from Raj Option Trading. Today I want to talk about how to buy call options. So with that, let's jump in. Buying call options is a capital appreciation strategy. You could do a lot of these small bets and buy your favorite stocks. You don't need to put so much money. Put little bit money, make some big bets, for these great growth stocks and sock it away. So with that, let's look at how to buy stock options, especially on growth stocks with a fair price and really a capital appreciation strategy. Instead of putting up so much capital, you can put a fraction of the capital and do a big bet on wider stock selections. And also let's look at strike selection and see how to select a strike price when you sell call options, and look at how to spot some ideal candidates. With that, let's jump in here and get started. What is a call option, you might ask, and why do you buy call options? You buy call options because your cost basis to compare it to buying a stock is very, very, very low. So that's why many people are attracted to buy call options. They can make huge bet. They might buy a stock like Tesla. If you buy stock, you have to pay so much money. But if you buy a call option, you pay less money. So that's why people are attracted to buying call options, so they can do some huge bets, long-term bets with a low price. And also greater return on investment. You're paying a little bit less money, but at the same time, your money can grow as stock price grows higher. So that's why a lot of people I know, they buy leap long-term stock call options, and some folks buy maybe say 60 90 days out, so that way they can do some nice return on their investment. And on the con side, not so great perspective, you can lose your entire investment if stock dives down below your strike price. This is one thing I always tell people: don't put all your money into call option. That's a sure shot losing strategy in case stock market tanks, like we had in COVID-19 time frame. I know a lot of people thought stock market will never come down. They bought a lot of call options on the margin and they lost money. That's why don't borrow money to buy call options, because when stock market turns and goes lower, you can lose your capital here. That's why be careful here. Just have it as one of the strategy. Don't have this as only strategy. That'll be really not great. And from a mitigation perspective, perform some nice fundamental and technical analysis and choose the right stock. We will look at those as we go forward. And also buy the stock at delta 70 or higher, so that way you're buy the call option at delta 70 or higher, so that way these call options have some intrinsic value, and they can also go higher as the stock moves higher. And also, if you are a little bit worried about this call option, I don't want to lose too much money, you can mitigate by buying a call spread here instead of call option. Only thing with the spreads is your capital, your money that you're making is capped here. It's not a unlimited profit potential. Your profit potential is capped the moment you buy call spread, but it lowers your risk potential. And avoid the stocks that are trending, keep going down and down and down. It's good to understand if the stock is gaining some momentum and buy them. And some people, if you want to buy long term call options, it's okay to buy stocks that are trending down, but don't buy when the IV percentile is high. And look at avoid the stocks with lower revenue growth and high debt level, and also avoid the stocks that pay high dividend. You don't want to get into those type of situations, and buy the options at least 3 months or more till time to expiration, so that way you got some more time on your favor. So that's always a good idea to buy at least 3 months out. And watch areas. Time decay works against you, so make sure at least this is when the stock goes against you, the time decay works against you. That's why look at the stocks that are trending higher, or go for a longer time frame for the growth stock, so that way time is on your side. And also, your premium paid will slowly evaporate as stock price is below your strike price. That's why you got to watch carefully, and don't put all your eggs into this options basket. Instead, have it as one arsenal in your tool chest. So with that quick picture here, I will not belabor this. Stock price is 40 here. As you can see here, you are selling a call option at 35 below the current stock price, delta 70 or so. So every time stock moves by $1, your delta 70 call option will move by 70 cents. That's the thought process here. And loss is below your strike price, you'll incur loss. Above your strike price, you'll start incurring the profit. As the stock moves higher, your profit accelerates. In this case, you bought a 35 strike call. As the stock goes higher, your profit potential keep increasing. That's the beauty of call options. If you select them right, you can have a small cost basis instead of huge cost basis. At the same time, nice appreciation. That's why folks are attracted to call option. They can make some small bet in multiple stock, long-term bets, and take it from there. Always, it's some folks buy out of money call option when the stock is at 40. They might buy 45, 50. That's one way to play, with some great growth stocks. But don't make huge bets there. Make some small bets. But always, many people I know, they make money by selling call options below the stock price, so that way they got some intrinsic value in the option. That's a better way in my mind. But unless you know the stock very well, you could go out of the money and buy some cheap options, but it's always a risky bet. And many folks in the shop, in the stock market, in the pits, they always buy delta 70 or higher, so that way they can sell this quickly. Don't need to hold it for a long time. So with that, let's look at the stocks here to buy call options. As you look through here, we got great growth stocks here. Look here, nice sales growth, nice gross margin, and also net margin in many cases positive. So if you're a conservative player, look at stocks like here we got Moderna, nice growth here, nice net margin, debt is low, and we got many other stocks here, starting with Stitch Fix all the way to Dropbox here, all nice sales growth. You can avoid the stocks with high debt here, like for example Bloom. I would not go with Bloom here, high debt ratio, and all the ones in the red here, avoid them, but go with the ones with the lower debt. For example, Urban here, and we got Moderna, and we got United Steel here, and Zoom Video, Micron, so on and so forth. Those are your safer candidates here with nice sales growth, even net margin positive in many cases, and low debt to equity ratio, which are in black here. And look here, I have made sure the IV percentile is low here. All these stocks have got low IV percentile. If you buy call option now, you're not paying too much. At the same time, RSI is low. Tells you these stocks are down right now. Good to buy call option. And many times, you got to look at stocks bouncing around. Look, Nutanix here, stock is down big time, and not Nutanix here. Next one, Bloomin, I think high debt ratio. Let's avoid that one. And next one here, Moderna, stock is trying to bounce in one day here. You could buy some call option here, participate in the upward momentum. Same story with a couple more here. Look, we got Iron Mountain here, trying to turn around here. You could buy some. Only thing with Iron Mountain is a little bit high debt ratio. I would probably avoid that one here and look after better candidates here turning around. We got few candidates over here. You could look at these ones here, DraftKings, TSM, all trying to turn around here, and even Toll Brothers. Those could be good candidates here. Always look at nice sales growth, gross margin, low RSI that's given, and also look at low debt to equity ratio, so that way you don't burn yourself with the high debt folks, and take it from there. And we got few more here, couple more here, Adobe, GameStop, Riot blockchain. All of them have got nice sales growth, as you can see here, low debt to equity ratio, low RSI, and also low IV percentile. You could buy call options on these type of stocks here, and have your appreciation in the stock, in the money that you invested. So what we'll do is probably we'll look at one stock here. For that, let's look at Riot blockchain, one of the great crypto play here. I'll go to Thinkorswim here and bring up Riot blockchain. So as you look through here, I will go to the chart quickly here. So as you look through Riot blockchain, great crypto play here. As you see here, stock is trying to see where to go here. Right now, low RSI, just 45 here. Stock is trying to slowly come back here. Smart money is moving into the stock, and on the balance volume is positive. You could go into option chain here. Typically, I would go higher. Maybe you could go 157 days out here. And right now stock is at 27. You could do delta 70. That puts you around, let's see here, 71 here. You could pay $6 here and buy call option here. Expiration date 18 March 22. Confirm and send. Boom. You're paying here $605. If the stock goes above $39 by this date here, 18 March, you'll make money. Your profit potential is infinite, so you could confirm and send this and take it from there. And we'll probably look at one more here. For that, let's look at let's see here, I'm trying to look at the stock that's turning around here. So let's look at probably this one here, Moderna. Moderna is one of my favorite stock, MRNA. So Moderna, as you look through here, let's go to the chart quickly. Stock is nicely pulling back here, trying to go higher now. Smart money is flowing into it. Nice on the balance volume, and check-in money flow is pretty steady here. We could go to Moderna and go maybe 184 days out. That's good here. Let me delete this and look at delta 70 as an example. Delta 71 is good. You could pay $72 and get into this Moderna play here. And instead of paying so much money for the stock, $311, you are buying the options at lower price here, just $72 here. You could confirm and send this, and see here you're paying here, your cost is 7,290. Your break-even point is 342. If the stock goes above 342 by 14th April, you'll make money. So this is one way to play. If you're not very comfortable buying it outright, paying so much money, you could do a spread also. Stock at 312, you could do an in-out spread. So you could go here 312, you could go 300, 320 spread. That's one way to play here. So right there, 300, 320. This is a little bit low risk strategy, buying the spread here. So as you can see here, you're paying here, $905 to make $1,095, doubling your money type proposition here. Typically stock moves around the current price here. That's why the spread, in and out spread, buying below and selling higher is a better strategy, because price moves around the current stock price. So that's why many people I know, they love to do spreads, in out spreads, sell, buy below the current price, in this case 300 when stock is at 313, and sell above the price. So it's an in out spread. You can make some good money with this and go from there. So with that, thank you very much. As usual, buying call option, bullish strategy. Make sure RSI is below 35, IV percentile is low, and make sure day to expiration is higher here, delta 70 or higher. With that, thank you very much. Happy investing and trading. Please subscribe.